Good morning. Thank you for joining the REV Group 2021 Virtual Investor and Analyst Day. My name is Drew Cunnop, and I head up the Investor Relations Department here at REV. While we normally take this opportunity to host the Investor Day in person and meet you all, we're excited to be able to reach everyone virtually this morning. First, a few quick housekeeping items. Today, management will be focused on sharing our strategy and future plans. As such, our remarks and answers will include forward-looking statements, which are subject to risks that could cause actual results to differ from those expressed here today. These risks include, among others, matters that we have described in filings that we make with the SEC, most recently filed during our first quarter earnings release in March. The entire event today will be virtual, and our presentation slides posted on screen. A copy of the presentations and slides will also be available at our website at investors.revgroup.com. Finally, we will reference non-GAAP financial measures, so be sure to check the appendix today for a reconciliation to GAAP measures, as well as the definitions in our footnotes. As you can see on this slide, we have a new and refreshed executive leadership team, many of whom arrived in the last couple of years or even more recently. Just this week, we announced the promotion of Mike Lanciotti to president of our recreation segment. Mike has been the VP GM of the Renegade RV business since 2008 and through its acquisition by REV in 2017 and leading up to this promotion. Here in the room with me today are several members of that executive team. They'll be presenting various aspects of REV Drive business system, our strategic vision, and financial targets. Rod will kick off the presentation with an introduction of REV Group and REV Drive business system. Anoop will follow with a discussion of commercial excellence, followed by Kent, who will present opportunities for platforming within REV. Brian will provide a look at operational excellence training and project work being done, and Rob will tell you what opportunities he's uncovered within the supply chain in just his first few months with us. Then Mark will give you the numbers you've all been waiting for by providing intermediate fiscal 2023 targets. After our Q&A, we'll turn it over to Rod for closing remarks. The prepared remarks should be about 2 hours, and at 11 a.m. we'll take a short break, allow our sell-side analysts to dial in for live Q&A. Everyone else attending is welcome and encouraged to submit questions directly to me via the chat box that's below the presentation. Nobody else will see the questions. They come straight to me. So I'll put them in the queue and we'll ask the questions as I moderate at the 11 a.m. Q&A session. So let's get started. I'll turn it over to Rod.
Thank you, Drew, and thank you to everyone for joining us today. We have quite a bit to share today. We'll present a brief review of the past year. We'll also examine the REV Drive business system that defines how we will manage our work and how to create value for our stakeholders. We'll close with Mark sharing our forward projections for the midterm. But I'd like to first start with a few themes that I believe you will hear throughout the day as we discuss our future. We have strong positions in end markets that we serve and generally hold a top 3 position. Our product businesses generally hold a top 3 position in the segments they serve. The markets that we participate in are stable markets and are benefiting from macro tailwinds. About 2/3 of these markets are funded by municipal tax receipts, which will be supported by the recent rounds of federal stimulus. The market positions are secured by brands that have endured for many decades and are taken to market by our channel partners that possess long-lasting relationships with our customers. Next, we are focused on improving our operational performance of this business, and I believe we are beginning to demonstrate great results. We will discuss this today, and I will provide a few examples of the work that we are doing. We are well positioned for strong financial performance in terms of margin expansion, cash flow, and a solid return on invested capital. Finally, growth. We believe we're in a very good position to grow organically with our strong brands, products, channels, and relationships. The foundation of the REV Group was industry consolidation, and there remains much opportunity here. We're positioned and committed to continue opportunistically to consolidate where the economics meet our criteria. A little bit about our history. The foundation of REV is a legacy of companies with enduring entrepreneurial spirit that has been serving our communities, first responders, families for decades. Emerging from this are strong, established brands, channels, and long-standing customer relationships. In 2006, American Industrial Partners developed a thesis of consolidation of specialty vehicle manufacturers. By 2009, all the product categories that are in the REV portfolio today have been placed in the portfolio. Following in 2010, Allied Specialty Vehicles formed, and a progression of transactions continued, resulting in ASV being renamed as the REV Group in 2015, followed by the IPO in January of 2017. Today, we are headquartered in Brookfield, Wisconsin, with roughly 7,000 employees throughout the U.S. Our business has three segments: commercial, recreation, and fire and emergency. Fire and emergency leads our portfolio in scale, but there is good balance between the three segments. Our commercial business produces Type A school buses, transit buses, terminal yard trucks, and sweepers. Our recreational business has a full offering of RVs from campers to towables to Class A. Fire and emergency offers a full complement of fire apparatus and emergency vehicles throughout a broad local market channel structure. Despite the events of the last year, we are beginning to see favorable macroeconomic momentum in our market stemming from changes in leisure choices, the stimulus, and attractive interest rates. That combined with a well-scaled position, solid stable underlying end markets, and a historical high backlog, we believe we are positioned quite well to deliver on the expectations and commitments. Our footprint is geographically spread throughout the United States and includes both manufacturing and service centers. This includes 21 manufacturing sites and 11 dealer and service centers. With over 4 million square feet of owned manufacturing space, we're also able to maintain a relatively low CapEx requirements of roughly $20 to $25 million per year. Additionally, we have a wide network of over 700 dealers. This enables us to localize our business and maintain critical relationships with our customers, leading to repeat business and stability in our market-leading positions. We estimate over 220,000 of our vehicles make up the in-service fleet, which represents roughly an installed base of $35 billion. This drives a healthy replacement and aftermarket service demand each year. Over 85% of our revenues occupy a top 3 market share position. Combined, our fire and ambulance divisions are the number 1 position in the fire and emergency segment. This past year, we acquired Spartan Fire Apparatus business. This included a fire chassis business that provides custom fire chassis to many other fire truck manufacturers in our industry. These OEMs make up roughly 30% of the North American fire apparatus market. Today, roughly half of our recreation business revenue is out of our Class A RV business. Our Class A RV has shown great progress and promise over the past 2 years with improved quality, award-winning new products, new dealer signings, and improved bottom line. Our Class A business has been gaining share recently and has moved into the number 3 position. It includes brands such as Fleetwood, Holiday Rambler, and American Coach. The other 50% of our RV portfolio is from businesses that have a very high profitability in high single to double-digit margin territory. Collins is the market leader with the number 1 share in the Type A school bus category. Our ENC transit bus business offers a diverse set of powertrain choices serving municipalities, universities, and airports. These 2 businesses were the ones that were the most impacted by the COVID pandemic. But we are pleased that we have seen quoting activity in these 2 bus markets showing progress and a more of a return to normal activity level. And finally, our specialty division, terminal trucks and sweepers, is also in the top 3 in their respective categories and have rebounded nicely from 2020 in market declines. 2 weeks ago, I celebrated my first year anniversary with REV. I thought I'd offer a brief overview of what we've been working on during this past year. Admittedly, we were challenged with a bit of a turnaround. In normal circumstances, a turnaround presents a full plate of activities. Our challenge was to navigate this during the pandemic. I am pleased with the work this team has done over the last year. There is much work still ahead of us, but this team and our employees have performed admirably through challenges, continue to serve our communities and our customers, and produce significantly improved results for our shareholders. During the year, we made substantial changes to our leadership, not only in the addition of talented personnel, but probably more so in our alignment and our priorities and how we organized around executing our work. You will hear from a few of these leaders today, and I believe our priorities, discipline, and urgency will be evident. We have made steps to simplify our business, to streamline our operations, and lower our structural costs. We have added talent in critical areas to our performance, put in place new capital structure, and just completed our Q1 with the best performing Q1 on record. Again, all of this taking place in the presence of the COVID pandemic. I would simply like to thank the team for what they have done together so far and assure our shareholders that the work will continue and that we remain committed to value creation opportunity here at REV. Our leadership team has worked to develop high-level principles that we will lead by. We are committed to eliminate complexity and simplify our business, eliminating waste and unnecessary bureaucracy. We are working to set up systems and processes to enable data-driven, real-time decision-making. Secondly, we are building an organization that operates with a sense of urgency and purpose, with intensity focused on continuing improvement in our performance. We are committed to both commercial excellence and operational excellence principles that will be a driving force in these behaviors in our business. Finally, we expect to be the leader in our industry, and being a leader means you must grow. Our growth will come through our resolve to understand our markets and our commitment to improve our products and services for our customers. All business transformations or change programs aimed at improving performance start with establishing a clear understanding of where you are and a definition of where you will be. We baseline and establish where we were early on and challenged ourselves to achieving a top quartile performance within our industrial peer set. We developed a plan to recapture the value that had been lost. We quickly took action in areas such as leadership changes, leadership alignment, elimination of unnecessary structural costs, but more importantly, by establishing an operational cadence and rigor with transparency to the details of our execution. As an industrial products company, having core capabilities in commercial and operational excellence is essential to achieving a high level of sustained performance. We immediately began to stand up these programs and are making solid progress in building our capabilities. Today, you will get a glimpse of these programs from our leadership team. Our next step relates to the core systems and processes within our business units. We have measurable variance in process and performance within our business units. We have a great opportunity to improve our performance by improving the underlying systems and transparency of our business and the processes that feed on this data. We will have data systems and processes that are consistent along our value chain, providing us the ability to leverage our OPEX capabilities for improvement and enabling real-time decision-making. The last element in our value creation is growth. I have said multiple times that much of our value creation opportunity lies within the walls of our business, and that is an absolute truth. However, we have solid market positions to capitalize on, and we have great channel partners to position us to grow above the market and to capitalize on our product investments. Additionally, our industry remains opportunistic for consolidation as we move forward. Later in the presentation, Mark will share our midterm 2023 targets. Our expectation is to grow above market. Our growth will come from organic and inorganic opportunities. Our goals remain to achieve 10% EBITDA margin and also believe we should achieve a 15% ROIC in each of our segments while converting at 90% free cash flow. Our top-line growth projection combined with our operational activities will yield a 10% earnings per share performance. To achieve these results consistently and deliver predictable, sustained performance, we have to have a methodology of how we run our business. Today, we are proud to introduce the REV Drive Business System. In the next few slides, our leadership team will walk you through, at a very high level, the construct of the REV Drive Business System and how it will work within our business to create value for our stakeholders. We will also provide a few illustrated examples of some of the early work coming from its implementation. The REV Drive Business System, simply put, it is guided by our vision, mission, and values. It is a framework on how our strategy drives our execution. It defines how we organize and align our capabilities. It is centered on value creation for our stakeholders. Let's take a brief moment to watch a video that provides an overview of the REV Drive Business System.
REV Group is a leading designer and manufacturer of specialty vehicles. We build and service customized vehicle solutions for essential needs such as ambulances, fire apparatus, public transportation, commercial infrastructure, and outdoor recreation. REV Group is a business in motion. And at the heart of our company is the REV Drive Business System. REV Drive reflects how we organize and work to create value for our employees, our customers, and our shareholders. It's our winning formula for success and creating a competitive advantage. Like a well-engineered machine, the REV Drive Business System identifies, prioritizes, connects, and aligns the company's capabilities to achieve our goals. The guiding force behind the system is REV's vision, mission, and values, which propel our plans and work in our pursuit to improve the quality of life for our customers and communities. Every day, thousands of REV employees live and uphold our values. and to produce and provide our customers with vehicles they can count on when it matters most. Which is why we believe our tagline is more than a slogan. It's our promise. The REV Drive business system encompasses every goal, plan, and capability precisely interlinked and working together with a focus on our stakeholders. The workhorse of the system is our commercial, operational, and organizational capabilities. They encompass how we respond to market opportunities, motivate and mobilize our employees, and produce our high standards of work. Each capability includes 5 critical functions made of dedicated processes and tools. These functions work together to form the foundation of excellence that creates value for our stakeholders. Data transparency and analytics are essential to delivering performance improvement. Through visibility to data and key performance indicators, we enable real-time decision-making to improve our operations. This results in greater commercial gains, better operational efficiency, and improved organizational performance. REV's performance imperatives are the critical elements that must be achieved to create sustained value for our stakeholders. They connect strategy to execution, focus resources, and direct our capabilities. They are measured and return to the strategic planning process to complete the loop for REV's continuous pursuit of excellence. REV Drive affirms our priorities and orchestrates the critical functions of the business to achieve our goals and fulfill our mission. The REV Drive business system is our winning formula to create value for our stakeholders.
In the next few slides, the leadership team will walk you through the elements of the REV Drive business system, providing just a few examples. The video presented our vision and mission, and I will touch on our values momentarily, but we will begin with a brief overview of our planning process. Our planning process can be viewed as a beginning point in a repeating sequence of activities. These processes are informed and shaped by our vision, mission, and values. Our portfolio management process assesses our current business holdings and external development opportunities to enhance our portfolio. This is a continuous process where we evaluate both tuck-in and transformational assets to enhance our strategic and financial position. Mark will provide insight to evaluation of inorganic opportunities in the few slides ahead. Our annual growth plan includes activities, actions, and investments to deliver organic growth. There are market-backed discussions that deliver technology and product roadmaps, as well as channel strategies by business unit to achieve above-market growth. Finally, our annual operating plans are developed to define our forward actions to deliver on our commitments in the pursuant fiscal year. These operating plans are subject to management execution cadence and rigor to drive performance to the plan and mitigate issues as they arise. Performance imperatives are critical elements that must be achieved to create sustained value for our stakeholders. Performance imperatives connect our strategy to execution by focusing and directing our resources and capabilities. Performance imperatives are measured by elements such as top-line growth, market share, margin expansion, employee engagement, customer satisfaction, and Net Promoter Score. The first REV capability is organizational excellence, consisting of 5 elements. The first is safety, as safety is our top priority. It speaks to our commitment to provide safe working conditions as well as our commitment to employee wellness, and incorporates our employee Bill of Rights, including the right to stop work under perceived unsafe working conditions. The second is our establishment of a performance culture, which includes our commitment to a diverse and equal opportunity workplace. Core to this is our performance management and performance-based compensation. Our long-term success depends largely on the strength of our employees and the success of our employees. We have to be recognized as an employer in choice who values their employees in our peer set in order to attract and retain top talent. To do this, we have to offer development and progression within our workplace and help our people connect with our mission of serving our communities and first responders. A business operating model is critical to driving sustained improvements. It defines how you organize and how you align around the work that must be done and includes role definition and decision rights. It's much more than just an organizational structure. It speaks to a well-defined operating cadence within the business, and it's understood and adhered to. Finally, our commitment to stewardship and the imprint that we leave on our communities. We are committed to operating in a sustainable way and to minimizing our environmental impact. The underpinnings of our organizational excellence is our commitment to our values of integrity, safety, teamwork, building trust, and finally, possessing an ownership mentality. I will now introduce Anup Prakash, and he will walk us through commercial excellence. Anup.
Great. Thank you, Rod, and good morning. Today I would like to discuss commercial excellence, which is a key pillar of the REV Drive business system. With 22 brands across 5 business segments, executing effective go-to-market strategies and developing compelling product roadmaps is essential to winning share. Through the work of the Commercial Excellence Council, which I lead across REV Group, we are focused on raising the bar for our sales, marketing, and product management teams to ensure we optimize each brand's performance and share best practices. Now, we define our work in commercial excellence through 5 key levers. First, there's sales force effectiveness, which is a comprehensive approach to account planning to retain and grow our key accounts and direct new resources to capture and conquest new opportunities, which we uncover through our business and market analysis. Second, we focus on channel optimization to strengthen our partnerships with our dealers, enabling their businesses to grow through investment in training, sales tools, and marketing support. We're also constantly optimizing the performance of our respective dealer networks, rewarding our dealers who consistently outperform. Third, effective sales operations inform our pricing strategies and demand planning through market intelligence and research, and drives growth and support in our aftermarket businesses. And fourth, our product management approach, which is anchored in voice of customer feedback, drives the development of new product and service offerings, placing REV Group at the forefront of innovation leadership in our respective segments. And finally, our marketing strategies, which amplify each of our brand's key differentiators and assert our market leadership, leveraging shared digital web and social media platforms and ensuring high standards of marketing execution across REV. Now, to illustrate how our approach to commercial excellence plays out across the organization, I'd like to begin with a case study from the REV Ambulance Group. In early 2020, as part of our strategic business review within the Ambulance Group, we conducted a comprehensive audit of product profitability and dealer performance. This work uncovered an opportunity to resolve brand and channel overlaps for one of our largest business units across nearly half of the country, as indicated by the state shaded in red on the map on the left side of the slide. After investigating, we found the emergence of this situation over time had led to dealer underperformance and created downstream impacts in the value chain, such as added manufacturing complexity, loss of efficiency in engineering and production, and growing challenges with inventory control. We developed a focused plan to resolve the channel overlap by preserving the most profitable products and brands and retaining our top-performing dealers. The resulting removal of channel overlap can be seen on the map on the right side. The initiative resulted in stronger partnerships within our dealer network and a focused brand strategy that better positioned our dealers to win. And at the factory, this action reduced our engineering and manufacturing complexity, resulting in increased throughput, focused product management, and operating efficiencies. We estimate that the near-term impact of this example to be over $1 million of EBITDA annually. An examination of our dealer networks and projects like this are occurring across REV Group and will continue as commercial excellence and continuous improvement become a part of the daily culture within each of our businesses. Now, another area of focus under commercial excellence is industry advocacy. REV is committed to being an advocate for the success of our own business, the industries we participate in, and for our dealers and suppliers. The importance of this work has never been greater, with the impacts of COVID-19 and the resulting rounds of federal stimulus money that will be entering state and local budgets over the next several years, which has the potential to reshape and bolster demand in many of our end markets. Now, while the CARES Act that was passed around this time last year was largely directed at individuals and business relief, approximately $150 billion was allocated to state and local government for response to COVID through the Coronavirus Relief Fund. The funding was made available for specific uses related to COVID response, including for emergency vehicles, and availability of these funds was recently extended to December of 2021. Now, as discussed in the Q1 earnings call, this has been a tailwind in our fire and emergency business, helping grow our fire and emergency backlog to over $1 billion. More recently, the American Rescue Plan, which passed in March of 2021, directed another $350 billion to state and local budgets, as well as $130 billion for in-person learning at K-12 schools and $40 billion in college and higher education funding. With over 65% of our revenue directly tied to tax receipts and municipal spending, this bill provides a level of budget security to local decision makers that they have not had through the past year. It also directly impacts efforts to get children back into the classroom, which we expect will impact new school bus orders for the upcoming school year. Additionally, nearly half of our transit bus business has historically been related to university and airport transportation. And this bill also gives us confidence that transportation needs at higher education institutions will benefit. Now, most recently, the initial framework of the American Jobs Plan proposed by the Biden administration has directed funds broadly toward the modernizing of public transportation, replacing 50,000 diesel engines and electrifying 20% of the yellow bus fleet. If this bill becomes law, a total of over $1.1 trillion of additional federal stimulus across all three bills will be provided to our end market participants. This includes a potential earmark of $174 billion for jobs to electrify vehicles. So as an industry advocate, it is important that we work with our customers, our dealers, industry associations, and government agencies to understand how these dollars will be allocated and support our customers as they pursue funding to support their new vehicle requirements. Now I'd like to shift to discuss product management, and specifically our progress on alternative fuel and electric product development. The transition to the electric powertrain across REV's portfolio will depend on unique characteristics in each segment, and each is likely to have a different path forward. Certainly, industry adoption has been varied to date, with transit buses a clear leader over the past 5 years, and the school bus market now enjoying significant momentum. But it is important to consider what makes a specialty vehicle market distinct from one another and what may impact the rate of adoption. Factors like route predictability, accessibility to charging infrastructure, and daily usage and availability requirements are all important drivers. These factors are relatively easy to determine for most transportation markets with set routes and time schedules. Often these vehicles are parked several hours a day, which makes charging readily available and could even be candidates for vehicle-to-grid technology. But beyond transportation market, routes are often unpredictable, and the time required at any location is uncertain. Other important considerations, especially within our fire and emergency segment, are the local requirements and mission-critical nature of equipment that must always be available. And for these reasons, we expect transit bus, school bus, and terminal trucks to lead the EV adoption curve, while fire and emergency and recreation will follow. Now, across REV, we have developed a broad lineup of alternative fuel vehicles and are actively pursuing the development of electrification platforms. Let us start with our commercial segment. Today, 95% of our Type A school buses are not diesel-powered, and we expect that to be 100% within a year. And we have started to deliver Type A school buses built on converted E450 chassis. Within the heavy-duty and tractor applications, we currently have zero-emission fuel cell terminal trucks in a pilot program at the Port of Los Angeles, and recently announced a partnership with Hyster-Yale for the development of electric, hydrogen, and automation-ready terminal trucks that will not only serve our ports, but are also critical for last-mile logistics and the fulfillment of goods across the country. At ENC, our municipal bus business, over 85% of vehicles sold today utilize alternative fuels, including CNG, propane, hybrid diesel, as well as hydrogen fuel cell. We are currently in a co-development program with a major powertrain provider for the development of a battery electric bus, which we expect will debut in calendar 2021. Now, in fire and emergency, earlier this month, we announced the renewal of exclusive rights to integrate and distribute idle mitigation technology, which will be offered across all of our ambulance brands. The system automatically starts and stops the ambulance engine to decrease fuel consumption and pollution, while also allowing the crew complete use of all critical functions, as if the engine were still on. This solution is an excellent way to mitigate the hours an ambulance may spend idling at a scene or waiting to respond to calls. And on the electric front, the ambulance group is also co-developing battery electric ambulances with Lightning e-motors and Ace Tech based on a converted Ford Transit chassis. And finally, idle mitigation is also offered within our fire group. And while we expect the fire industry to be the slowest to adopt a fully electric solution, we are in the development stages of an electric-powered North American-style fire truck with alternate backup power capabilities to ensure continuous operation at an emergency scene. So as you can see today, some of our markets are adopting hybrid solutions or retrofitting traditional chassis on a unit-by-unit basis, while others are in development stages of technology that can be applied across a fleet and new product. We have a growth mindset and expect to lead the commercial vehicle industry in the adoption of alternative fuels and electric offerings that solve the needs of our customers and reduce the impact on our environment. For each of our segments, when the market and the technology are ready, we will be ready. I would now like to pass it over to Kent Tyler, President of the REV Fire Group, to discuss platforming opportunities within REV. Kent?
Thanks, Anoop. I returned to REV last year, but have a long history with REV and the earlier holding company, Allied Specialty Vehicles, dating back to 2006 and across several of the businesses. Today, I will be talking about platforming strategy and the opportunity that exists not only within the Fire Group, but also across all our divisions. First, let's step back and define what we mean by platforming within REV and how it creates value. Fundamentally, platforming is the sharing of designs, components, or subsystems across multiple REV offerings, likely within the same end markets such as fire or ambulance, but potentially across all our end markets. Platforming creates value by simplifying our operations from sales and configuration to procurement to manufacturing, and by enabling us to capture economies of scale in engineering, purchase components, and production. Essentially, we can engineer and test something once, purchase components in higher quantities, and utilize it across multiple businesses or product lines. However, it starts by understanding the voice of the customer and identifying where differentiation is truly required and valued. In these areas, we need to maintain the uniqueness of our offerings and brands, although doing so in the most efficient manner possible. Parts of the vehicle that are not visible or important to the end customer provide opportunities to converge to platforms with a common design utilized across multiple products or brands. Looking at REV, many of our businesses, especially in fire and ambulance, have similar offerings playing in the same end market. For example, we offer Type 3 ambulances under 5 brands: Wheeled Coach, Road Rescue, Horton, AEV, and Leader. Today, these offerings share relatively little in terms of common designs or components, as each was developed in isolation by the legacy business, often prior to consolidation under REV. But by employing a platforming approach, a product might go from being nearly 100% unique to sharing 70% of the design and components with other products, while maintaining the 30% where differentiation really matters. This same complexity and opportunity exists in our fire businesses, perhaps even to a greater extent. I will take you through some examples of how we are platforming across our fire brands to simplify and drive scale while maintaining unique brand identity and differentiation. If you look at how the REV Fire Group was formed over time, it really began in 2008 with the acquisition of our largest fire plant, E1, in Ocala, Florida. Over the years, we added to the fire and emergency portfolio and bought other fire companies, including the KME business in Pennsylvania, Ferrara in Louisiana, and most recently we acquired Spartan Emergency Response, which included Spartan Chassis, Smeal, and Ladder Tower, with a wide footprint across Michigan, South Dakota, Nebraska, and Pennsylvania. It gives REV Group a wide net of top brands and experienced dealer channel to win incumbent business and take away bids. Other companies may only have one bite at the apple with a single brand or a dealer, while we may have 4 or 5 strong dealers or a direct relationship to that firehouse, which increases our ability to win that order. In fact, we have a total of 111 North American dealers, plus the Spartan chassis business also sells into 30 other OEMs. That equals about 30% of the North American market today. As Anoop discussed, we certainly have opportunity to optimize channel activities within a commercial network of this scale, and always working to enhance the performance of all our dealers. Conversely, this type of scale and wide product portfolio brings additional manufacturing complexity and significant opportunities to improve manufacturing efficiencies. As you can see, we have 8 primary locations with a total of 35 Fire Group manufacturing plants with a total footprint of 1.8 million square feet. Across that footprint, we historically have made choices about which components and subcomponents are made at each site versus purchased from an outside supplier. Because these were historically independent companies, this had resulted in a great deal of duplication of efforts when it comes to engineering, design, and even manufacturing. For instance, we currently make chassis at 4 of these locations, bodies at 7 of these locations, and pumpers in another 7 locations. These activities are supported by 4 separate engineering staffs that, until recently, have focused primarily on their unique brand and spec their own suppliers based on the local internal team's designs. As we take a more centralized and holistic REV Fire Group approach, and the engineering teams are structured as a unit and working toward a common end game, we will not only drastically cut the number of SKUs, but also make deep step change engineering advances that result in a more streamlined portfolio that drives manufacturing efficiencies. But before we do that, we need to understand what makes our brands unique and what our customers love about the trucks they buy. For example, what is the value proposition of E1 versus Ferrara or KME versus Spartan? A few examples from our Voice of Customer feedback are listed below each brand on the left side of this page. These have been abbreviated for our purposes today, but a quick example is that our E1 aerials are known to be lighter weight due to aluminum construction versus a KME, which is a reputation for heavy-duty application due to steel construction. You also see cab differences such as form cab versus an extruded cab. There are literally dozens of factors that we research to determine preferences and distinguishing brand features. Other examples may include how big is the cab and what height is its roof. Is the entry to the cab 2 steps or 3? That can be a big difference if you consider the amount of gear worn by fire crews. Where are the HVAC and lighting switch controls? Is the windshield tall, medium, or short? And what are the visibility requirements? These are just related to the cab and are not at all inclusive. The features listed here distinguish between the brands or may be critical for the function of a particular fire station, so they must remain unique. However, there are many opportunities to converge designs or components that are underneath are simply not seen or valued by the customer. A few of these are on the right side of this page. A good example is emergency lighting. Is the particular brand of light important to the performance? If the performance is matched, the same could be said for the engine cooling. If performance is met or exceeded, we can begin to converge between our brands while maintaining or even improving the quality. Today, we'll look specifically at cab door construction. The REV bonded door project is an example of platforming that rationalizes cab doors across REV fire brands without sacrificing the unique brand identity needed to support our separate distribution channels. The first implementation of the REV bonded door will be on the KME Severe Service cab. The current Severe Service cab is an overbuilt aluminum welded assembly that is difficult to manufacture. The amount and placement of the welds causes the door skin to warp, which in turn requires quarts of body filler and nearly 8 hours per door to restore it to smooth and flat condition prior to paint. The REV bonded door design eliminates welding entirely, eliminating the bodywork and allowing the manufacture of the door assembly by lower skilled employees. The door assembly is fixtured to produce repeatable doors every time. Hand drilling and tapping is replaced with pre-punched holes and automotive-style captured fasteners. Internal door latch rods and clips are replaced with modern cable actuation that reduces the negative effects of part tolerance and produces a more consistent latch activation. Federally mandated safety standards require this type of certification. The variability in designs across the brands necessitates 7 instances of certification, testing, and analysis be performed by third-party labs. The REV bonded door will allow us to satisfy various door shapes and handle configurations across all of our brands with a single set of analysis and certifications. Sourcing advantages are also gained by reducing part numbers and consolidating suppliers. After final project implementation, latches, linkages, seals, molding, window regulators, and electronics will all be common. This increases part volume, drives down cost, and simplifies service logistics. A final segment advantage is the consolidation of door design product knowledge and support from 4 engineering locations down to 1. The principal design tasks can be accomplished at the group level with only the implementation needed by the individual brands. So you can imagine the savings potential for projects like this and the opportunities for other applications across the fire group and, quite frankly, within all of the REV groups. We are also focused on leveraging our best-in-class facilities. Earlier I mentioned 35 manufacturing plants across the group with many sites duplicating efforts by making the same components, such as at several different plants. We are thinking differently about the need to make everything at every location versus what we can effectively purchase from an outside vendor or supplier. If any of our manufacturing processes results in underutilized equipment or labor inefficiencies, we are examining if we can outsource that item to a fully utilized outside provider that can run their machines 24/7 while keeping our own production lines optimized. Or maybe one of our own plants is better suited or can be utilized to focus in its design and manufacturing across more than one of our brands. Making these decisions to streamline and optimize will have several payoffs that drop to the bottom line. A prime example of choosing a center of excellence is our recent decision to private label the existing Spartan, Metro, Star, chassis, and cab into our other brand channels under a quick delivery program. The benefit for those dealers is that this product meets the needs for departments with impacted budgets who may be looking for quick delivery or lower cost alternatives to a more customized pumper. This is a pre-configured pumper combined with customizable cab and chassis, providing the benefits of a custom pumper built to their specific needs, but within a menu of options that provides a quicker turnaround at a lower cost. For REV Fire Group, this expands the channel of distribution for Spartan chassis to include and encompass other REV brands. This type of program was done within other business units many years ago when I was with REV Group, and we see it as an attractive model for several of the current REV portfolio companies. Thanks for your time this morning, and now I would like to turn it over to Brian Perry to discuss operational excellence within REV.
Thank you, Kent, and good morning, everyone. Today I will be discussing our approach to operational excellence at REV. Before I cover the details of this slide, I'd like to revisit a point Rod spoke to earlier during the organizational excellence section. For our leadership teams, there is an overarching priority that blankets every aspect of what we do at REV, and that is the safety of our employees. During our monthly cadence of business unit operations reviews, we begin each meeting with a discussion around our safety performance and our leading behavioral indicators like near misses and employee job hazards. Beyond just the individual business unit, This dialogue provides an opportunity to share best practices or uncover potential safety issues at other sites across REV. One recent example was related to proper ladder use within a plant, where difficult-to-reach areas of a truck provided temptation by the employees to use shortcuts like leaning too far over the vehicle or standing on a tire, etc. Upon discovering this potential hazard, we have implemented deeper safety training and ordered specially shaped ladders designed to reach uncommon heights and angles for our manufacturing areas. So back to the slide. Operational excellence is fundamental to how we create value. As you saw in the earlier slides, REV has 21 primary manufacturing locations. Many of these locations have several production facilities within those geographic sites, making the total number of physical plants much higher. Given this complexity in our diverse business structure, it's essential that we have a center-led approach for structured training and process capability building that standardizes our approach to our 5 key operational excellence levers. First, quality must be built into every process we use in every vehicle that we produce. The success of our brands and market depend on us delivering highly reliable products with the performance that our customers expect. By creating a culture of quality performance in manufacturing and in the supporting functions, it improves process repeatability and ultimately helps reduce or eliminate warranty issues. Second, relative to design, our costs and outcomes in manufacturing will almost always be dictated by the strength of our engineering processes. Product platforming, design for manufacturing, value analysis and value engineering, and how we apply advanced technologies all have heavy contributions towards cost savings and improving our production processes. Third, our purchasing teams and our external suppliers are such an important part of our success, since so much of what we build into our vehicles comes from our supply base. How we develop our suppliers and manage those partnerships plays a huge part in our ability to run our factories at predictable rates and keep our manufacturing teams working efficiently. Fourth, our supply chain management practices help us ensure predictable material availability for our manufacturing teams while optimizing inventory levels and our inbound and outbound logistics costs. And finally, and perhaps most importantly, our manufacturing execution marries all of the above-mentioned levers with the skills and dedication of our well-trained workforce. Our pursuit is to run our manufacturing lines at predetermined, predictable rhythms with no unplanned interruptions or major swings and variation. Since all of what I've just covered contributes to the success of our manufacturing operations, we are focusing on applying a significant portion of our Lean Six Sigma training to our manufacturing operations teams. I will cover this training focus in detail in an upcoming slide. So if you think in terms of value creation, each one of the chevrons on this slide is a significant step in REV's value chain process. From pre-production sales and design activities, engineering the vehicle, production planning, the manufacturing process itself down the production line, and even our aftermarket services for our customers. Each is critical in the value chain processes and provides opportunity for daily improvement. The goal behind our OPEX program is to manage with data, utilize that data analysis to drive improvement actions across every one of these steps. As you can see from the graphic, we have a circular process of pulling data, understanding the data, and driving improvement actions from that data. Better data will lead to better decisions and ultimately better performance that can be applied on top of our improved operations. At the front end of the process, which is the left side of this chart, we are targeting a significant amount of improvement prior to the vehicle even starting in the manufacturing space. Our product development and design activities flow into every aspect of the subsequent downstream areas. How we design for manufacturability, which considers factory flow and assembly methods early in the design process, along with product platforming and how we approach our decision to make versus buy portions of the vehicle, all play out in cost considerations that we set targets for and then maintain accountability to those targets. Next is how we configure price in our products in a way that not only ties back to our design processes in the previous step, but also properly links to our cost management targets in both material and labor inputs out on the production line. The potential for reducing complexity at this configuration and sales stage is significant. It is also an opportune time to ensure that we are properly charging for complexity that has been built into the design and holds value for our customer. Sales configuration management and formal pricing practices are key areas for data management feedback loops and are a core focus across our sales and general management teams. Application engineering and production planning are very much intertwined. Adhering to our established design standards and creating a highly accurate bill of material is key for us to execute appropriately in the supply chain and in our manufacturing spaces. We are implementing a rigorous process called Clear to Build, which requires every production facility to have a clear process for a line of sight that all materials are available prior to even starting a vehicle in production. This stabilizes our manufacturing environments and allows for our lean activities to target additional waste elimination, while also allowing us to use our Six Sigma methodologies to further reduce process variation from one vehicle to the next. There is a balance that must be maintained here. If production starts on a truck and ultimately a component is not available, the production line could stop, or the truck must be taken out of the line and worked on later. This is clearly not ideal efficiency and disrupts the daily rhythm of the factories. On the other hand, we don't want excess inventory of components to be held just in case. This is another example where data is plentiful, but a systemic approach to gathering and managing it is a key to success. The next stage, manufacturing, is ripe with opportunity for our employees to examine each element of their job and find ways to do it more efficiently. So to this point around employees being able to examine each element of their daily job and find ways to do it more efficiently, here is a more detailed look at the training cycle that we are currently running to bring as many employees as we can into the tent of daily improvement. We are purposely doing the training across every aspect of the business with a bronze belt, green belt, and black belt approach so we can engage every employee, whether they're frontline production workers or engineers in our design areas, all the way up into our middle managers and even the executive offices. Building this capability and formally recognizing it through this belt certification process has a big element of professional development for our employees that gets them invested in this process for the long term and is obviously a cultural enabler for REV. We are working to build out a long-term organizational culture that has an appetite for improvement as part of its DNA. People are investing in themselves to go through this training, leading and participating in improvement projects, and putting in the time to get certified because they know it's going to pay off long-term dividends for them professionally as well as for the company. Over the past 2 quarters and through today, we have had over 500 of our 7,000 employees in one form of training to advance these concepts of waste elimination with our lean training and variation reduction utilizing our Six Sigma tool sets. There's a focused subset of our broader training rollout called Design for Six Sigma, where these candidates are being recruited from our engineering leadership ranks. They will be leading projects targeted to take out design costs from our current portfolio of products, along with any of our new product offerings in the future. On the right side of the screen, you can see an illustrative chart of how our pipeline of projects is being built out since the onset of this training. There are currently 385 active projects and more being added every week. Measuring and executing against this pipeline is part of the operational team's cadence to build annual savings through a growth funnel of opportunity. Continuously planning, reviewing, and approving new projects is fundamental to the certification process rigor of this training that we're rolling out, as well as the candidates and REV success. All of these project activities have highly interactive and reoccurring oversight from the executive leadership team that you see sitting here today. So for my closing slide, I wanted to share an example of a KAIZEN, or a continuous improvement project, being worked on by a team at one of our business units. So I'm not sure how many of you know the whole concept behind 5S. This is something that was derived many years ago out of the Toyota production system in Japan. As you can see in the upper right side of the slide, there are 5 elements to it: sort, straighten, shine, standardize, sustain. Simply said, it's really focused on organization, visual management, and the functionality of the work area for the employees. Like most things in life, if you come in every day to a messy, disorganized environment where you're looking for your tools, perhaps you're missing parts that go into the vehicle on the production line, there can be this sort of mayhem feel or sense that the work environment is going to be less productive. There is also a strong argument that there would be lower levels of quality and, of course, a higher likelihood of safety risks and injuries, potential injuries. So for me, the whole premise behind 5S is that it's a very meaningful foundational element to lean and to waste elimination. There is a place and order for everything, and the resulting sense of organization creates an environment of higher focus and quality of work being performed. We often use colors and other visual management enhancements to organize where things go within this work environment. So there's a term that I use called fit, form, and function that broadly applies to every process that we do in the factory and what tools we do it with. That focus almost always translates into better efficiency, better quality, and better overall performance of the workforce, which you all know at the end of the day translates into better efficiencies and bottom line performance for the business. This team in the example initiated this event themselves, so their environment would be more productive and organized. They went through a detailed look at their workstation processes to understand what was needed and, more importantly, what was not. They organized their station and inspected for safety concerns. And you may also note that they did use colors and created visual management tools. And as a result, you can see at the bottom of the slide that this one project is expected to save around $20,000 annually. So if you think back to 385 projects that we currently have in the pipeline, and the fact that we're all looking at all aspects of our operations at all of our plants to continue to expand this funnel of savings opportunities, it gets to be very exciting to think about what can be done. Many will be smaller projects like this one, while some will be much larger and have a greater savings impact. So one area that we see significant savings opportunities is within our purchasing organization. So now I would like to turn it over to Rob Vislowski, our Chief Supply Officer, to discuss how we plan to attack that area. Rob?
Good morning. I've been with this amazing organization since the beginning of the year, and I'm excited to talk about our strategy, tactics, and execution that I believe will lead to significant improvements in supply-based management for REV. As background, I joined the team with over 25 years of expertise in supply chain and sourcing in industries as diverse as electronics to heavy industrial and automotive, from chemicals to plastics and packaging. Over that tenure, one consistent theme that separates good supply results from world-class is ensuring that fundamentals of sourcing excellence are applied consistently and done in tandem with the business and the supply base. Applying those fundamentals is a cornerstone of our supply base revolution and part of our vision to drive value as one REV team, maximizing supplier quality, productivity, technology, service, and delivery in a comprehensive total cost model. Let's begin by discussing the size and complexity of the supply chain that we are managing and how leveraging our supply mosaic sets the table for REV to find immediate value. REV Group has a dynamic and interesting supply profile. Traversing a spend in excess of $1.4 billion, we have an active supply base of over 6,300 suppliers. Those suppliers support a complex SKU and component puzzle that is close to 1.8 million pieces of active items. When you separate our indirect from direct spend, we have a cut that is greater than $200 million of leverageable costs for services and non-bill of material items for the corporation. This creates a unique opportunity to harvest the untapped power of this amalgamated complex. When considering how to derive value from a complex mixture of heavy equipment components to indirect services, we look to the four fundamentals of supply-based management that, when applied, drive sustainable savings results. The first fundamental is optimizing the supply base size and type, refining the total population to a more manageable subset. Second is targeting our raw material stock keeping units, or SKUs, with specific cost out kaizens to reduce the total cost of our raw material recipe. Third, and most importantly, is to develop alternative suppliers, creating a 3D approach to qualified alternatives that we can switch from and to in order to capitalize on market conditions and as well avoid supply chain disruptions. Finally, and in joint development with our engineering and operations teams, we will look at our total design for complexity reduction opportunities as part of a comprehensive value engineering and analysis program set. Over the last 4 months, and based on these fundamentals, we have developed a world-class strategy that is the playbook for driving supply-based value with speed and precision. Let's talk about how this 5-pronged strategic sourcing approach is constructed, then discuss how it is driving value right now for REV. Our 5-pronged approach to strategic sourcing excellence embodies a well-planned structure that is not only effective, but elegant in its simplicity. To begin, we focus on implementing a productivity engine with our supply base. This engine begins with supplier planning for year-on-year productivity at the part level. By bidding all major suppliers annually, we can maintain competitiveness while onboarding new and innovative vendors. A bid-it-all structure supports a mercantile-like exchange that generates powerful energy from a supply side that has historically not been challenged every year for improvements. As part of our new Supplier Summit series, we are now communicating this plan outwardly, and the feedback from new and incumbent suppliers is creating momentum like never before. Secondly, a focus on working capital excellence will not only demand better payment terms in exchange for enhanced partnerships, but develop well-run vendor-managed inventory programs. The analytics behind this approach also will help our planning side as we align economic order quantities to minimum order quantities, driving the optimal buy-side increment with true purchase-to-purchase savings. Lastly, and now in the process of kicking off a supplier refinancing program that we expect will help our suppliers' cash flow while creating an exchange for extended terms for REV. Digital procurement transformation is the nucleus for our strategic sourcing strategy. Effective this month, we'll be partnering with a world-class provider of e-sourcing tools that will drive spend analytic excellence, electronic sourcing, automated e-auctions, procurement to pay, and source to contract optimization. The supply-based management culture that we are instilling in REV is a game changer. We are now developing supply chain risk management approaches by refining our supply base, creating executive connections at the very top of our suppliers' organization, and a supplier-driven productivity process. We believe this approach will ensure REV is at the forefront of innovation, supply guarantees, and productivity from our base of vendors. With the onboarding of new suppliers as alternatives, we will be creating a solvent supply chain pathway that REV was not enjoying in the past, bolstering our ability to produce where others might fail. Our strategy is nothing without a talented organization. The fifth and most important aspect of our strategic sourcing approach has the keystone of training, talent management, and injecting fresh ideas with a diverse and well-educated supply-based employee population. We have added specific leadership roles at each division that we expect will now drive savings from the leveraged REV to the divisions in an efficient and collaborative manner. Productivity engine, working capital excellence, digital procurement transformation, supply-based management excellence, and talent management create a powerful strategic subset to launch best-in-class results. These results don't come without a solid tactical execution plan. Let's now talk about our plan for tactical execution and its impact over the next few years. Over the next several years, our revolution in supply-based management will have a tactical tool subset that mechanizes sourcing approaches, leveraging our digital capabilities, and supporting immediate value realization. KAIZENs, continuous improvement approaches, exist in our supply-based management in two forms: supplier-based cost Kaizens and business-based cost Kaizens. Each has the same goal, improvement in costs, but attack the opportunity from two flanks. With a supplier-based cost Kaizen, over the course of a dense and intense one-day event, we review all supply nodes, materials, services, and technology provided by a specific supplier. With intense scrutiny, we review the total cost of delivery, define innovation, and cost reductions. The second type is a business-based cost Kaizen, doing the same as the supplier Kaizen, but is focused on entire cost structure of the business specifically. Over the course of 2 to 3 days, we review everything spent at the business, finding ways to improve productivity and implement cost controls immediately. Our digital sourcing approach is driving e-auction and spend management activity that did not exist just a few months ago. This suite of sourcing tools, being applied over the next year, is designed to clean our spend data and execute savings auctions with harmonized bidding packages and unmatched quality in supplier management. Finally, the application of supplier-derived value engineering should bring to bear sustainable savings beyond purchase price. As an outcome, we expect to enjoy a surge in savings from this level of technology-focused engineering cost analysis that will be a hallmark of our supplier partnerships. Our supply-based excellence journey will expose areas of opportunity historically untapped by REV, which is why we are confident in value creation over the next few years. As these processes mature, and the majority of our supply base is touched by these new approaches, we expect higher returns with lower input costs. We have discussed our vision, strategy, and tactics to accomplish our revolution in supply management for REV. What is even more exciting are the actual examples that have begun generating value now from these approaches. Let's look at 3 tangible success stories that are a product of this approach. The first example is the business-based cost Kaizen. Being conducted at the business unit level, we review every component of costs in a rigorous and repeatable process. Out of the box, we've identified realized value between $2 and $3 million, split between material savings, energy consumption, working capital management, total consumption reduction, and operating uptime. We have found a balanced way to chase out costs quickly across all components within the business in a repeatable approach. The second example leverages the brain trust of our suppliers to drive out costs from all areas of their supply chain through to REV. This approach challenges the supplier to act as part of REV, scrutinizing all aspects of their cost structure. Treating our suppliers as we would employees connects us intimately to our suppliers, and that partnership has proven to reduce costs using this concept by $1 to $2 million annually. In the last 3 weeks, we kicked off our digital procurement transformation by executing our first e-auctions. Selecting a diverse set of direct and indirect spend areas, we have successfully bid items in an inflationary environment to find an average of 11% savings. This is an outstanding accomplishment considering the market conditions and proves the capability of e-sourcing with our supply base. We anticipate using electronic sourcing tools as part of a true digital sourcing revolution that is totally new to REV, bringing immediate value. As you can see, I'm very excited about our strategy of revolutionizing our supply side, generating sustainable shareholder value that we see as a game changer for REV. Now I would like to hand off to Mark, who will discuss shareholder value creation and our financial outlook.
Thank you, Rob, and good morning, everyone. Value creation is at the core of the REV Drive business system and is focused on bringing value to all our stakeholders, including our employees, customers, and shareholders. We have focused objectives and actions directed at value creation for each of these stakeholders. Today, I will focus on the priorities that we have put in place to specifically drive shareholder value creation. It begins with participating in stable end markets and achieving above market growth. As Rod mentioned, we have over 220,000 installed vehicles and 85% of our revenue is in the top 3 market share positions, which creates an annual cadence of replacement demand and aftermarket service that results in stability in our end markets. With that foundation, our commercial efforts that Anoop covered are aimed to grow above market, and added dynamics, urbanization, and in some cases urban sprawl, may lead to incremental growth, as will additional federal stimulus, mandates, and reimbursements. Expanding our proposition for feature-based selling and added growth through price realization will add to our top-line expansion. As we pursue our double-digit margin goal, we are targeting 30 to 40 basis points of EBIT margin expansion each year by establishing core OPEX capabilities that Brian and Rob highlighted and applying that OPEX on better performing businesses. Finally, by leveraging our low capital requirements and the variable cost structure of a largely assembly model, we are in a position to convert a significant percent of our earnings to cash. We target over 90% conversion of adjusted net income to cash, which we will deploy under a disciplined capital allocation policy that I will cover on the following slide. When you look at our value creation and the balanced use of capital, Our use of capital begins with maintaining a strong balance sheet and targeting a leverage ratio in the 2 to 2.5 times range. We seek to grow our existing portfolio businesses organically using growth CapEx and investments that exceed internal rate of return targets adjusted for the risk profile of the project. Externally, our markets remain fragmented and there is significant potential for accretive M&A activity. Our target leverage ratio comes with a willingness to stretch to 3.5 times for a deal that fits our strategic profile and opportunities to extract cost and commercial synergies. At this time, it is likely that we would remain in our existing verticals, in opportunities, or an opportunity to advance development of adjacent markets to our current commercial vehicle lineup. As our net debt decreases and the bottom line increases, as indicated by our fiscal 21 guidance, we expect to approach our target leverage, opening the door to inorganic activity. We expect any deal that we transact to pass a hurdle rate of ROIC to be greater than our weighted average cost of capital in year 3. Outside of these growth initiatives, and as we think about returning cash to shareholders, we will also consider establishing a competitive dividend yield that is consistent with a sustainable payout. We also plan to direct targeted and opportunistic share repurchases to offset share-based compensation dilution in the future. The order you see here is our preference and feel the best use of capital to increase the value of REV Group and provide the greatest potential shareholder returns. Before we discuss the intermediate financial outlook, I'd like to first look at our historical financial performance. Over the last 4 years, revenue has grown at a low single-digit rate, which is in line with our expectation of GDP-type growth. This period does include a fair amount of inorganic activity during that time. We added several businesses within the fire division and RV segment, and there were also some divestitures within the commercial segment, but over time, revenue has remained fairly consistent. This revenue pattern, combined with strong order intake in all segments over the past year, has resulted in our backlog nearly doubling from $1.1 billion in 2017 to $2 billion at the end of our 2021 first quarter. So the company has had a relatively stable top line and growing backlog. However, resulting EBITDA and margin performance has not performed to the level of expectations and quite frankly has declined since the IPO in 2017. The 2021 EBITDA midpoint guidance of $130 million is a result of many of the activities we have discussed here today and is a step change improvement from fiscal year 2020 and puts us on a path to advance our long-term financial targets. Turning to free cash flow, you will note that there is an upward trajectory in cash generation since an outflow of $80 million in 2018. Our 2021 guidance is for over 90% cash flow conversion. Over the past year, we have expanded our focus on cash earnings with efforts to expand customer advance programs, working with both customers and vendors on payment terms, teaming more closely with each business to understand optimal inventory, and of course, are focused on driving profitability to generate net income that can be converted to cash. Put simply, we are keenly focused on converting revenue to earnings and earnings to cash. In fact, we have updated our management compensation plan to reflect a balance of EBITDA and net working capital performance. In the past, a business may have been compensated for achieving one of 2 targets, either increasing EBITDA or improving net working capital. They would have done better in the past to do both, but could have been rewarded for only one achievement. This was not aligned with how we think about value creation, and the plan now creates a matrix for improving both earnings and delivering cash. Prior to leaving this slide, I wanted to touch on some early observations, priorities, and initiatives I've addressed within the finance function since I arrived last year. First of all, I was happy to see that despite the uneven bottom line performance, we had a solid financial team in place, especially related to the controls and regulatory reporting needed in a public traded company. I did feel there was room for increased rigor and improvement in the business operational reporting and visibility into day-to-day business level performance that would give us an opportunity to identify variances against our plan and external commitments so that we could take corrective action immediately. As a result, we enhanced existing and added new metrics and content for weekly, monthly, and quarterly reporting and operational review calls. In addition, we improved our reporting around the balance sheet, identifying inefficiencies and monetization opportunities, and enhanced our cash flow forecasting in line with the efforts I previously mentioned to deliver greater than 90% cash flow conversion. As we have disclosed over the past 3 quarters, we have also exited several non-performing activities, including our centralized parts business, the REV Finance rental business, and our REV Brazil operation. With improved reporting capabilities comes the need to analyze the data being generated, for we also invested in FP&A resources. With 16 businesses and even more manufacturing locations, it was important to not only dedicate resources locally and at division level, but also add a center-led corporate staff that provides standardized processes and support to ensure consistency of reporting that we currently use to identify the performance of each business and take corrective action when needed, or even share best practices across our enterprise. Earlier, Rod talked about our cadence of annual operating planning and commercial growth plan reviews that sets our vision and financial expectations for the next 3 years. To support the realization of those outcomes, we have added and will continue to add technology and talent that can have immediate impact on results as we build out greater support for tracking price versus cost that Rob talked about, savings from consolidation and platforming that Kent discussed, and tracking overall OPEX pipeline that Brian's team is building. As we reflect on the roadmap of value creation that Rod discussed earlier, if you think about 2020 being our baseline at $68 million EBITDA, the $130 million EBITDA midpoint of fiscal year 21 guidance in box A reflects the near-term actions that we took in the second half of fiscal 2020 to reset performance and recapture value, which results in a near doubling of EBITDA on a year-to-year basis. You saw the beginnings of this work demonstrated over the last 2 quarters with sequential and year-over-year margin improvement. Particularly noteworthy was the strength of our fiscal first quarter as compared to prior years. Although the first quarter will always be impacted by a lower number of working days with holidays and downtime at many of our customers and suppliers, we were able to mitigate the impact on our bottom line in this year's first quarter. So we feel good about the work that has been done to this point to deliver on our fiscal year 2021 commitment. Having a new baseline as a result of the reset of performance reflected in our fiscal year 21 guidance, our intermediate target provided today anticipates growing at market in each of our segments as shown in box B. One thing that we haven't discussed yet is the aftermarket opportunity now that we have placed the parts business back at the individual businesses. This business has grown at a healthy high single-digit rate over the past 4 years to approximately $100 million of revenue. By changing its structure, not only have we eliminated duplicate costs, we feel the service and delivery times to the customer will improve, providing potential upside in the parts business top-line growth rate. Also, because it is now directly in the business P&L, it becomes a focused profit center for the local teams. The parts business is very high margin and will continue to be an opportunity for top-line growth. We also expect to see expansion in additive areas such as ambulance remounts, which has become an important driver in the industry. It allows the ambulance life to be extended by placing our sturdy box onto a new chassis. It also is a perfect time for the addition of other add-on features and even potentially the electrification of a unit as the industry evolves. However, significant share gains and other results related to our commercial excellence initiatives are not reflected in our intermediate target, but provide the potential growth above market captured in box E. Establishing core OPEX capabilities aligned with the strategies that the other presenters talked about earlier fall within box C and D. You saw the employee OPEX training programs that we have in place and the growing pipeline of projects which is off a low base. These projects are fundamental to delivering the annual margin improvement that we have tasked each business to achieve. Rob provided a few examples of early traction on material savings that he and his team are gaining on in our $1.4 billion overall spend, and we are confident that this work will continue to build in fiscal year 23. There are longer tail projects for procurement and OPEX, such as the engineering cost out and platforming mentioned earlier. We also envision our bronze, green, and black belt team numbers to grow, and will continue the ability to identify waste and eliminate it. All of these are captured in box F as second wave improvements. The next phase of our long-term growth is in box G and represents inorganic investments that I discussed earlier as part of our capital allocation philosophy. Putting it all together, we provide a bridge on the page for the expectation that we have for the progression from the 2020 baseline of 3% EBITDA margin to our intermediate fiscal year 23 target of 7% EBITDA margin at the midpoint, an increase of 400 basis points over last year. As you can see, the majority of target improvement over this time is within our control by improving the execution in our businesses, leveraging volume growth, and releasing value trapped in our four walls. Core principles in the areas of engineering, platforming, and procurement that are being installed today will provide an opportunity to realize additional EBITDA as those programs begin to take hold and gain traction. So turning to slide 48, our fiscal 2023 targets include organic growth in the fire and emergency segment of 1% to 3%, in the commercial segment 5% to 6%, as we expect the school bus and municipal transit bus markets to recover from COVID-related impacts, and limited growth within the recreation business as we offset any potential end market declines from this unprecedented demand level that we have experienced over the past 9 months with market share gains and category expansion. Margin performance for the fire and emergency segment is expected to be in the 7% to 8% range as we begin to see the benefits of our OPEX pipeline, as well as the initial benefits from the integration and convergence of our 5 businesses that Kent mentioned earlier. Fire and ambulance markets are also likely to benefit from recent and proposed federal budget stimulus aimed at improving health and safety standards. Commercial segment EBITDA is expected to be in the 9% to 11% range, and increased volume from an expected normalization of demand improves productivity. Recreation segment margin expected to be in the 8% to 10% range. As you may know, about 50% of revenue in the recreation segment is from businesses with low double-digit EBITDA margin, but the remainder is from a Class A business that had recently struggled to reach profitability. We have seen improved performance within this business and will strive to achieve industry margins at both peak and trough, which would result in a segment that is much less cyclical than it has been in the past. We target returns on invested capital in the mid-teens for each segment and a consolidated basis, with some variation between the segments, as you can see here. Looking at the bottom of the slide, the bottom line is a result of, from 2020 EBITDA of $68 million, we have guided to nearly double that at a midpoint of $130 million in fiscal 21, and our intermediate fiscal 2023 target is $180 million. With our plans to generate over 90% conversion of adjusted net income to cash, cumulative free cash flow over these 3 years is expected to be over $230 million. On slide 49, in closing, I'm very happy to announce we recently announced this past week a change to our capital structure from our former term loan A and ABL to a new $550 million 5-year ABL revolver with a $100 million accordion feature, which has a borrowing base comprised of AR, inventory, fixed assets, and select real estate. Our initial draw of $311 million to repay our term loan A and existing ABL leaves us with $218 million of availability, with the ability to expand to $318 with the accordion feature. This new structure allowed us to capitalize on low interest rates and will save REV Group approximately $3 million in interest expense in the remainder of fiscal year 2021 based on the current debt levels. This structure is also covenant light with a fixed charge coverage ratio of 1.1 times only when availability on the revolver is less than $80 million. With total availability of $318 million at close, we have ample liquidity to fund our near-term and future objectives. With that, I'll turn it over to Drew before we take a short break.
All right, thank you, Mark, and thank you, everyone. That concludes our prepared remarks. Strong coffee in the boardroom this morning. We finished just a little bit early. We're going to go ahead and take a break for before our Q&A session. A couple of reminders. For those dialing in, if you could go ahead and add your name to the dial-in, that'd be helpful as I queue up the next caller. Also, for those that are participating and not dialing in, go ahead and forward any questions in the chat box below. I show 10:26 Central Time. Why don't we take a couple minutes back and reconvene at 10:35 Central Time for Q&A, and we'll see you then. Hello, everyone, and welcome back to the Q&A portion of the conference. I'd like to go ahead, and we're going to go to the live callers to start, and we're going to go with Joel Tiss at BMO. Go ahead.
Wow, look at that. I'm not used to being first. Well,
hey, Joel.
I
how you doing?
My biggest question is, I wonder if you guys, if there's any way to kind of give us rough buckets on the sizes of the savings for each one of these initiatives. And maybe you don't have to be that specific, but some of the bigger buckets, like plant consolidation, product rework, dealer excellence, share gains, new products, purchasing, some of those different buckets. You gave us like specific examples of, stuff you're doing on the factory floor, which seemed pretty substantial. But if you could put it into bigger buckets, I think that would be hugely helpful.
Yeah, Joel, maybe I'll take that one. I think we probably won't give that guidance right now as we continue to build those pipelines. But obviously, if you look at the math, just, with our long-term expectations of 30 to 40 basis points improvement, obviously going from 3% to 7%, we've built in, those buckets to exceed that 30 to 40 basis points improvement over the next 2 years. So as we continue to build out the pipelines that we talked about in purchasing as well in OPEX, we'll continue to deliver those during the earnings call. But at this point, we're not going to just take some multiplication and provide that guidance against the project, sort of like Brian had laid out there. We hope the fruits of the labor result in some nice pipeline, which I think we're seeing here. But as far as how it strictly is going to roll out, Kent talked about the platforming opportunities. We're in the early phases of that, so we know there's opportunity there with some of the things that we've done to start off with, but we really haven't bucketized all those to that level of granularity to get to get that specific at this point. But as we progress and as we finish out 21 and enter 22, obviously we'll definitely have more prescriptive guidance as that is related to those activities.
All right. Am I allowed to follow up?
Sure.
Yeah, of course.
And I wonder if, as you guys go kind of product line by product line and business by business and all that kind of stuff, is there anything that falls out, a couple of areas or maybe product lines that you start to feel like, these are never going to get to where we need them to be? And, or you're more in the mode of like, let's look at all the data and figure it out and maybe make acquisitions to support some of the weaker pieces?
Yeah, I think that, you go back over the past year and you think about the shuttle business that we divested of. Obviously, that gave us some cash to address liquidity things. But that business, we weren't the right owner for that business. And you think about the fundamentals on how that business was performing. It wasn't going to be one that we were going to be able to get to where we needed to get to. That's a good example. But as I look more broadly at our portfolio today, I think about aspirations to double-digit margins, and I think about the ROIC targets that Mark talked about. All of our businesses can meet one or both of those expectations. I think one of the things that Mark commented on was our Class A RV business, which we're seeing, and I mentioned as well, we're seeing solid improvement in the performance of that business. That when you think about the industry peer set in terms of where margins are at, what the cash flow looks like in those businesses, we think we're going to be able to perform at a peak and trough in the space that makes that business a viable part of our portfolio, and also is a necessary part as we look at RV more broadly. So there's stories to each one of the businesses, but as we stand today looking at them and the execution and coming through the COVID, I think that we have glide paths that put us with each of the business the potential, and that doesn't necessarily mean that we're always going to be the owner of all these businesses. It just means that the execution plans would suggest they could meet our financial criteria for the mid and longer term. With respect to additional businesses, we probably won't get into specifics there, but that is an evergreen process. We talk about all the time as we emerge from kind of performance purgatory here and get our legs underneath us and start executing, and we get our debt structure to where acquisition is an option. Some of the things that we're teeing up are going to be realities for us, and there's areas that we do have keen interest in that we think we're really a good solid owner for, and maybe even some things on the longer term more transformational. So that's something that we're going to start exploring more seriously as we exit and get our debt paid down this year and get us a spot where we can get those earnings to be very accretive to our bottom line.
That's really great. Just one real fast one. Are the systems already in place to be able to do this kind of big data analytics that you guys are talking about, or is that something that has to be built out? And then I'm done. I'll leave it for everyone else. Thank you so much.
Well, let me ask you a clarifying question. When you say big data, are you talking about in terms of customer-facing technologies that allow us to provide analytics for customers? Or are you talking about across our value chain and what we need to get done in order to be more effective in applying our operational strategies? Which one are you referring to?
Hey, Joel.
Yeah, more on the second part.
Yeah, I think
Or your
each of these
operational
businesses,
strategy,
and Mark can provide the more detailed, but I think each of our businesses in terms of their underlying transparency and data systems are at a little bit different spot. We got to get them all to a spot to where that the data that we get in real time allows us to make decisions that affect production. A lot of that's just standardizing processes, so we know we're in a flow spot to where when we start something that we can actually finish it. So it's more disciplines and whatnot. But I think that this isn't what I don't want to leave with the impression is the work we're talking about doing is not a massive ERP transformation. It's more around labor tracking and bomb quality of bombs, processes around clear to build. They're big block things that we can go execute on, but we haven't got that in all of our businesses, and we actually right now in the process over the next 12 to 18 months are going to be going through that and doing it with each of our business units to yield that on the back end so we can be more effective in applying our operational strategies. I don't know, Mark, if you want to add something.
Thank you.
All right, thanks, Joel.
Thanks, Joel. Our next question will be from Mig Dobre at Baird. Go ahead, Mig.
Hey, good morning. Can you hear me? Can you hear me okay?
Yes.
We can hear you.
Great. So a lot to digest in the presentation. Thank you for taking the time to assemble all this detail for us. I guess my first question is some of the elements that you all have covered. They're not entirely new to the company, right? I mean, the supply chain optimization, for instance, is a good example. It's something that we talked about in the past, and to some degree, even this concept of platforming, which makes a ton of sense to me, at least, is something that I feel like we've heard about in the past. So I guess my question is this: as you look to your strategy, what is fundamentally incremental or different than what the company has done in the past? Because again, I presume that you're continuing some of the things that were already in place or accelerating them, but you're also adding some new elements to it. And I want to make sure that we all have an understanding as to what those are.
Well, I think that it's a good question. It's a fair question. I think that I can't comment on what was said in the past. I can only comment on what was getting done. And the things that we're talking about standing up here, platforming as an example, supply chain excellence. I mean, there's talking about it and there's doing it. And I think that we're really focused on doing it now. And I think that many of the programs that we discussed today, I think we've made great traction. We couldn't have produced the results just in the brief year that we've been working on it without making some traction. But these programs were not in place. And so platforming engineering was not something that was on the table. We certainly had a supply base and we had a working relationship with our supply base, but the proactive management that Rob talked about and the professional kind of structures he's put in place to go drive performance excellence around procurement were not in place. So they're being put in place. And I think that's going to give us great leverage going forward. But when we came into the situation last year and started talking about what the art of what's possible, we didn't have a running system in these areas to go lean on. We had to stand them up.
Okay, so in effect, all of this is kind of truly incremental to the organization. That's essentially what you're saying.
Sure, Mig. We're trying to build the pipelines, right? And I hope that's the sense you got here today, is we just didn't want to do lip service of what a strategy is. We actually gave you tangible examples, and that's why when I was talking to Joel, I think we're building a nice pipeline here, but to quantify it and make sure that people are actually delivering on it, that's what we want to make sure that, like we keep on saying, we're a do-it organization here, and we want to prove to you that we're going to deliver these results. So hopefully we've highlighted some of those examples. Even though they were small, you can see some of the initiatives that the employees are taking. So not only is it a top-down, but it's actually culturally at our plants that they're taking the initiative to drive these. And that's really important. When you say, are these incremental? Once we get the culture in place, once we get the OPEX culture and the savings delivery culture, and as Kent talked about, it's not only going to be about my business, it's about how I can improve the fire business overall with this platforming opportunity. That's really the key here. So we're starting to build that culture. We have some really quick wins, which was important for the leadership as well as our local teams to believe in these programs. And we're confident that we're going to deliver on the commitments for 21, but also build that pipeline, like we said previously, to deliver on 22 and 23 as we've laid out for the 23 midpoint. That's really important here.
Okay.
It's really going to be a show me result.
Sure. Understood. Then I think I want to ask maybe Joel's question on margin a little bit differently, and hopefully you can tackle my version of it. Perhaps you're not giving us buckets in terms of where the savings are coming from right now, but just conceptually, right? If we're looking at fiscal 20, that year is on the books. You had gross margin of 10%. SG&A as a percentage of sales was about 8.5%. That's essentially how we got to that 3% EBITDA margin. We're driving for, call it 7% plus EBITDA margin. You've done that historically. Looking back, it was fiscal 17 that you got there. Your gross margin back then was 13%. SG&A as a percentage of sales was, call it about 8%. I'm trying to see if just structurally, if that's kind of how you're thinking, that's essentially what's embedded in this EBITDA margin target. Yep. And then related to this, maybe my follow-up would be this. When you're looking at your peers and you're benchmarking the company, how do you think about the right sort of gross margin for your business given your current business mix? Thank you. Long-term gross margin.
Yeah, I still think, we're still, and again, on the EBITDA margins, we're still trying to drive, to that, over double digits. But obviously we're focused on not only in the short term here as we are approaching that journey, but what kind of returns we are getting and return on invested capital like we've highlighted. Because we do have some, great performing cash businesses like Rod talked about the Class A business. As it's turned around, we know the industry itself is in that Class A is not over 10%. But when you look at the cash that business provides and the ability to use that cash to invest in other opportunities and white spaces, that's what we're looking at. So I think when you look at overall margins, we're still, and I think they're conceptually where you said, that 8% in SG&A. So if you're just doing the back of the math, where we can get from a margin perspective and drive that, ultimately, I think that's framed up very well like you did to get to the 7%. So I think we'll still continue to see movement within our cost structure as we look at opportunities to reduce our SG&A, but we also have the opportunity to expand margin. I would say if you look at, and when you do the math on what we laid out there, we actually will have an acceleration of margin expansion to get to the numbers that you were quoting in 23, which will be more than the 30 to 40 basis points that I've talked about. So these pipelines and other things that we see that we're building, we're definitely, the 30 to 40 basis points is more of a longer term. As we get to steady state, we're definitely not in steady state. We have a part of the resets done here in 21. We continue to see reset opportunities, to your point, on our peers, but also internally on what we can deliver. So I think from a 22, we'll still continue to see some what we call reset of performance in 22, and the additive initiatives that Rob talked about that would be more accelerated than what we would expect in a normative 30 to 40 basis point sort of industrial margin expansion story.
Just to one quick follow-up here, but am I right to sort of think here that the longer term goal for your business and what's reflected in that 10% EBITDA long-term goal is really getting this business to mid-teens type gross margin?
Right.
Because when I'm looking at
Yes.
your other competitor
Yes.
out of
Yes, it
Wisconsin, that's basically what
Yes,
they're
it
at.
is. Yes, definitely.
Okay, thank you.
Anything else, Mig?
No, I'm all set. Thank you.
Great. Thanks, Mig. I'm going to go to an online question. It's similar. I think it'll pick up on that line of questioning and maybe direct it at Mark. Kind of again on this line of 7% EBITDA margin in the year 23, and then the 30 to 40 basis points on top of that. Does it take 7 to 8 years to get to 10% is kind of the question. Are they thinking about that right, or is there something incremental on top of the 30 to 40 basis, which is just kind of the run rate as laid out as in the OPEX program?
Yeah, so just like I mentioned to Mig previously, to getting to the 7%, we're definitely counting on more than a 30 to 40 basis point margin expansion from all the initiatives that we talked about today. And likewise, we're not counting on growth above market. So in that midterm, 180 million includes growing at market. So some of the things that Anoop talked about and some of the stimulus tailwinds that are coming at us would obviously accelerate some of that. So beyond that, so when we think about 3% to 7% to what can happen beyond, like I said in my on my prepared comments, we do have an acceleration opportunity beyond 23 to the extent stimulus continues to grow, as well as the initiatives that Rob talked about. So I think you think about it as 180, sort of the midpoint or the lower end of our range when you look at 2023. Given that we were saying we're going to grow at market, so our ability to extend past that are really the initiatives and how quickly we build those pipelines. But you got to remember our backlog is 12 months. So when you look at the timing of when stimulus comes in, when the orders come in, and when we actually can fulfill them, that's a 22, 23 type acceleration that we'll see. So again, we're laying out a midterm goal, but ultimately we're still reaching towards that 10% margin, bottom line margin expansion here, or margin realization.
Yeah, just a couple comments to add on to what Mark just said regarding the stimulus. So Anoop did a great job of kind of painting the landscape of the two pandemic bills that got through that gave us some stimulus money, and then the pending infrastructure, whenever that shape that takes. I think the way we went through is kind of what we hear, what's proposed right now. But the effort we have to have commercially, and what Anoop talked about, is how do we, once those monies become available, is how the municipalities connect up to it. So the sales organization we have to connect those dollars to the local communities. That's what we have to do, working in our channel roles to make that happen. And then, as Mark just talked about, selling it and converting it. So we're all excited about what we see as potential that might happen regarding the monies that might be available to bolster local municipal budgets. But there's a lot of hard work and heavy lifting around connecting those dollars to the municipalities to get the funding, doing the deals that takes a bit of time, and then the deals converting. So the timing of all that is hard to estimate, but we're obviously optimistic. That's why we included it in the presentation today. That's a good sign for our industry in general, and we expect as a leader to do well with that. So
I'd like to pick up on that thought with another online question that touches on it and maybe a little further expansion. With so much stimulus coming into REV's end markets, they said they struggled to marry that with the 1.5% to 2% top line revenue guidance that we provided, and we did bucket it out into different segment growth rates. But maybe just a little bit of color. They ask what's constraining REV. I don't know that it's a constraint, and RV was baked in there at 0 to 1% growth. But
I think that the stimulus part, I just somewhat kind of answered that one. I think that we're not constrained. First off, that piece was carved out of the walk to the point that Mark and Drew just made. So the monies that would come into our industry that allow us to grow above market related to stimulus, that wasn't in the CAGR in the midterm outlook. So that piece is separate there. And then I think related to the question about RV is, right now everyone in the industry is benefiting from the RV volumes going up tied to the COVID, but this is a longer cycle, and we know that industry does have cycles in terms of volume. What we've said from the very beginning is that we want to, as we participate in that industry, you can't change the cyclicality of it. We don't know when it's going to peak and trough, but as it operates in a peak and trough, we have to stabilize our performance so we normalize where we know we'll be operationally and inflex our costs. And that's the work that's being done. It's being done very well in Class A. And with Mike coming on board in RV business and having the great track record he does operationally, we see that as an opportunity. Now, I do think there are things that in the RV business now that we have a leader on that segment for us from a growth standpoint to mitigate the downturn of an industry that might come through product expansions, category expansions, and continue to evolve our product concepts there that allow us to maybe hold serve in a downturn. We have work to do there, but I think that the commitment we've made now, putting someone to run that business, that's going to give us a leverage point to go do that with. So I think the point being is, when you look at stimulus, we've purposely carved it out because we got to go connect those dollars up and then they got to flow through. And RV, it's just kind of trying to figure out the cyclicality of that industry and what it looks like over a longer period of time other than just the year that we're in right now.
Okay, we're going to go back online. Steve Volkman from Jefferies, go ahead.
Hey guys, thank you for taking the question. I guess sort of in the spirit of you get what you pay for, I'm curious in terms of kind of various incentive compensation programs that you guys have. How do your mid-level guys make money here? Are you tying it to, parts of this program? Any changes kind of that you're thinking about there?
Yeah, so I'll start and Mark can give you more details around the math. One of the very first things we did when we baselined the organization to figure out where we wanted to get to and the things that we wanted to go drive, those being earnings growth and efficiency on the balance sheet, conversion to cash. We purposely aligned everyone in the organization around those payout points in terms of what they had control over in their line of sight. And the philosophy is always you get paid for what you do and you get paid for the level that's up. So if a fire business unit participant would get paid for their efforts in converting cash and generating EBIT, but they'd also be paid on the fire business in its totality, and all around aligning the pay for performance to what our shareholders gain value for. So this year it was a lot around, kind of the structure and making sure that you needed to do both, not just one or the other to get paid. But the longer term and what we put in front of the board last year is considerations for just the points that Brian talked today around the things that are controlled around these OPEX targets is how we make that part of the incentive program, and I call them strategic efforts that are things that are important to drive forward performance. So we want to align our incentives around what our shareholders value, and we tier it to make sure people are always tied to that, plus the day-to-day things that they're driving.
Okay, great. And sort of unrelated follow-up, the $100 million of part sales that you mentioned, what do you think is kind of the fair amount that you should be getting in whatever your long-term sort of view of the company is?
Mark, you got that?
I think we have opportunities there, something of the, I think the total size of the prize, I wouldn't have a view right now on that as we continue to see growth there. So, coming in over the last year here, obviously it was centralized, and now we're actually seeing the ability to grow there. So we're in the early stages, Steve, of what the businesses are going to be able to perform. I can tell you, though, if we look at historically what we've done, we have seen an advancement from the individual business units from what was currently done or previously done in that central view. So I would say, towards the end of the year, as we have decentralized and actually can see some run rate to these businesses and what they're able to do, we are seeing some things, being an OEM provider of aftermarket parts is different than bringing an aftermarket provider of parts, right? So we now have become an OEM, so we're actually seeing some dealers come back to us and actually having us sell parts to them, where before, as we were competing with them or seen as aftermarket parts with our centralization efforts, they were doing it on their own. So we're still working through that, but as we get a progression here through what the business units are actually able to do and build their channels and strengthen it, we'll probably be able to be in a position position to give you a better view of that as we go through the year here and heading into 2022. I know it's probably not the answer you want to see from a size, but we're still going through that ourselves as we build this organization.
All right. Well, I'll just ask you again in a few months.
Great. Perfect.
Thank you, guys.
Yeah, thanks, Steve.
Thanks, Steve. I have one, Jamie Cook from Credit Suisse sent me one over the chat here. What challenges is REV experiencing on the supply chain shortage side, and what are we doing different?
So I'll start that. I think that we do have periodic challenges. They're almost on a daily to weekly basis that we're actively managing, and I'd have to give Rob a lot of kudos here in the proactive way he's engaged our supply chain partners at higher levels to make sure that we have surety of supply. So I think like everyone in our industry right now, we're challenged on a daily, weekly basis. We have issues that are related to weather, related to chips, related to big swings in demands, COVID issues that are driving issues in the supply base. Typically on a tier 2, tier 3 level is what's affecting us a lot right now, we're seeing. But the good news is that we haven't had any challenges that we haven't been able to manage through and continue supply and continue production with a reasonable amount of inefficiencies created from that, and nothing that's to this point that's had any impact on any forward projections that we've given. So it's a lot of work, and I give Rob and his team a lot of kudos because they're engaging with our business units to get on things quickly, to find alternatives, and to this point, we've been able to work through every issue that we've had. But again, it's across all of our businesses, particularly in RV. We're seeing it like all RV suppliers are, but we're managing it very effectively. But it's a lot of work. Rob, I don't know if you got anything you want to add to that.
Yeah, intensity on making certain meeting our commitments, and strongly partnering with our suppliers to do so, as well as our operational team. And that nimbleness is allowing us to get through this.
I know, carrying on from Rod's comments, and I know we've had separate conversations. Someone asked what has changed fundamentally here, especially on the supply side, but obviously bringing Rob in and the experience he has and the touch points he had coming from Honeywell and the experience he has really been a step change, not only from active negotiations and how we bring the supply base and develop them, but the relationships he has. And we've said several examples where we were maybe touching somebody lower in the food chain at our supply base, where Rob is now going and talking to the VP level person at that supplier. So I think we definitely, during this process, it's been very important to bring Rob in, someone who has those touch points that we've been able to address at a higher level than we traditionally have. So that's also been, just fundamentally from a process perspective, how these things get addressed.
Next question is from Jerry Revich at Goldman Sachs. Jerry, you could go ahead.
Hi, good morning, everyone. Nice to see you all.
Hey,
morning, Jerry.
Nice to see you, or hear you.
I'm wondering if you could talk about how you folks are managing input cost inflation in this environment. Obviously, really strong backlogs for you folks across the portfolio. I'm wondering if you could talk about if you have visibility on the cost structure, when you're looking out 9 months, where some of the products lead times are and how you're managing this environment.
Yeah, Jerry, definitely, and I think we've touched on this before. Obviously, there was untapped opportunities. So as Rob talked about, some of these activities we've been very happy with, where we were facing, 5-6% price increases, and we go and do an e-auction, and we actually get savings off of that. So some of the activities we're doing right now are just a rebalancing of what our costs should have been and delivering on those. So in the face of having increases, we've been able to go out and actually get reductions through some of the processes that Rob focused on. But, from that perspective, we do have visibility to inflation. We've talked about that before, our ability. We do have some indexing contracts where we're able to pass on to, like, the cost of chassis to our customers, but also other opportunities. And we look at the raw material increases. We've talked about that before, that we have very prescribed process in there, as well as knowing what the spend is. We do hedge some aluminum going out, but it's like we talked about day to day, addressing those. But I think we've been able to bring in with Rob's team and address incremental savings that we wouldn't have had before to offset any of the incremental inflation that we're seeing. And that's sort of when we came out with the 21 guidance, that was consistent there. We're not seeing anything that is beyond what our expectations were around our ability to offset the inflationary factors that we're seeing in the market. And it's traditionally now, not traditionally, but it's more impacting us on the RV side as I guess across everything. But Rod mentioned we have shortages in RV, but also it's mainly in the subcomponents that we're dealing with here, not the raw items that come through. So it's really on a supplier by supplier basis that we're addressing these, as well as trying to integrate and implement the processes that Rob brings us. So I think coming out of this year, we'll have a balance of, we had inflationary pressures, we were able to get incremental savings to offset those, but how do we build the process in place to deliver incremental savings as either inflation continues or if it has a drop off here exiting 21 into 22. So I think the team's done a great job. I couldn't be more happy of what they've been able to deliver, our full visibility to it, as well as the interaction with our supply base. So I still feel very confident that we won't be speaking about the fact that our inflationary factors are higher than the incremental savings we've been able to deliver and our commitment.
Yeah, and I just add a couple of comments to that, because I think about it in two ways. One, I think about it from the construct of commercial activities and price forward. As we create the work that we'll do in the future, then you have the existing backlog that we have to do, the things that Mark just talked about, more of a hand-to-hand combat around aggressively getting in our supply base, working for them with cost out, all the things that Rob's doing to make sure that we mitigate and we execute. And we're comfortable that all the numbers we've committed to, including are inclusive of inflationary issues we might deal with, that we're able to offset. But the other piece of that's when you think about the culture that you're trying to create and the transparency and systems on our businesses, is we've done a really nice job of taking price to market. I think that the market's receiving price right now because they understand the conditions we are. So all of our businesses, our segments and the business units are moving price into our forward demand. But we're also doing a lot of work, and this goes back to the work that we talked about, is understanding the price-cost relationship, how our CPQ tools develop our estimated cost, what that's based on, and making sure that we have inflationary factors addressed in our forward-based demand so we can get price on an inflated cost that's anticipatory of any inflationary issues we might face in the business. So and for the backlog we have, we're executing, we're comfortable to deliver that inclusive of addressing inflationary pressures. On a forward basis, it's around price-cost disciplines to make sure you're taking price to market, but you also understand that what your standard cost is relative to your last price paid, and your CPQs are reflecting that, and you're pricing your bombs correctly so that when you do convert that, you're in a good spot to convert margin on top of it.
That's terrific. Obviously a challenging environment, so that's great. And in terms of when we look at the roughly 200 basis points of improvement over the next 2 years, can you talk about how that cadence looks? How much of the improvement should we expect in 22 versus 23? Are you willing to touch on that at all?
No, I don't want to touch on that right now. We sort of gave the midterm, and like I said, there are some assumptions there that we're addressing. So let's continue to see how 21 ramps here, and we'll be able to provide you better insight into 22.
Okay, and then can we expand a little bit on the platforming opportunity? Obviously it's an evolving process for you folks, but as you think about for each business, what's the potential opportunity in terms of common components relative to the bill of materials? Can we just step through a range for each business and where that stands now, just to give us context?
Yeah, that's a really complex question to answer. I wish I had that answer to give to you, but it really it will be different. To your point, your observation there, I think it will be different business to business, and the platforming opportunity, from my view, is best suited for our fire business and our ambulance business. I think Kent alluded to that, but I don't have a number. I have a wish. I think that but it does start. The thing I think it's really important, because we want to make sure that our customers, that we're responsive to our customers, that you have to have a clear understanding of the brand value proposition and what that brand means in the market, and make sure you push yourself hard to challenge the differentiation needs. But you have to think about the brands have to have the specability and the identity in the market, so they stand on their own, so our channel partners can win, and so the end market customers can get what they want and what they pay for. And so outside of that differentiation process is where, when you go through this from a product management standpoint, you find that common set of things that aren't on those differentiation lists, and that becomes the answer to the question that you just asked, which we don't have today. It's a lot of work, and Ken gave you a couple examples, but the totality of figuring that out and how much design cost benefit there might be from it is a lot of work, and we're at the early stages of that work, to be very frank with you.
I appreciate the discussion. Thank you.
All right. Thanks, Jerry. I've had a number of questions online regarding the top line ranges that we gave. I think the best way to sum it up is, there was a question that phrased it this way: which business segments and competitive markets are most ripe for share gain opportunities as the internal initiatives are implemented?
Yeah, I think, I'd answer that question. All my presidents here would probably be disappointed if I didn't say they're all going to grow. But I think, from a pure product investment and share play, setting aside any inorganic activity, I think all of our businesses have the opportunity, because I think really cost, quality, and delivery, and improving on that and getting a better view of what the feature set and product platforming is a driver for growth too, to the effect that it hits your design cost. I don't know that I'd see any of our businesses. I'm pretty excited about what I think we can do in RV. We're obviously the smallest player in the RV space. There's a lot of product segments we don't touch there, so there's opportunity to go places that we're not, that would be accretive to a share position. I think ambulance, we have opportunity to grow. We have a healthy ambulance share, as you know. And fire is another business. I mean, it's no secret that we've struggled the last few years around some core commitments that are core tenets in the business, like cost, quality, and delivery to our customers. And as we get competitive lead times, as we get better product platforms and better feature sets, I think our opportunity to grow, setting aside inorganic activity in fire, is pretty solid as well. We could go to transit bus. I think that we're a small player in the transit bus space too there, and I think that it's been under a lot of pressure here all players the last year. But I think as that emerges and we get our EV platform out there and continue to work on these alternative fuel answers, that we have opportunity there as well. So I don't look at any of these as being a lost loser that we can't grow, can't take share. A lot of this is around how you deliver and how you innovate around your offerings, and I think that we got good work going on in all the business that should give us an opportunity to gain share.
Just pick up on the RV portion of that answer. Several questions actually. RV had been in the past speculated or under a strategic business review. This week you announced a president of that segment. Is RV core to REV? What can we expect from the REVs or the recreation segment in the future for growth prospects?
Well, it is. I mean, obviously we put someone in place because we believe in that business, and we've made a decision that it's part of the portfolio now. And I think that it's not because we're going through a euphoria of growth right now. Obviously that helps our position and what we're trying to accomplish this year. But it's a belief that that's a business that we can get a great ROIC in. We think it's a business that we can have a good earnings profile. As Mark said, 3 out of our 4 businesses there right now are double-digit businesses. And if you look at our 3-year midterms on the performance on margins and on ROIC, it stands up pretty well as well. And I think it has, as I mentioned just previously, it's got growth opportunities. So it's a tenet in our business right now. I mean, we'll always evaluate things going forward, but right now I believe it's here to stay, and we're gonna go deliver, and we're focused on execution and product concepts to put us in market segments that we're not at the scale position that we need to be.
And then one final, excuse me, how does REV Group engage its employees, and how does it track or measure employee engagement?
Okay, so the past year has been really challenging for engaging employees because of the distances we have to keep. So we've been trying to do a number of things. When you think about frontliner engagement, it's a lot around roundtables, it's a lot around town halls, and those are made very, very difficult when you've got constraints around physical proximity that you can be in. So first off, we're going to stand up the types of things that you would expect, those types of events. We've made a leadership where we have alignment of our leadership. We have calls to make sure we're communicating there. But today we don't have a formal, what you'd call like an engagement survey or engagement measurement. But that, I mentioned that today, obviously, is part of our REV Drive. That is something that we will have, so we get a measure of our employee involvement and engagement in the business to understand where the health of the organization is. So that's not something we've stood up yet, but that is something that I believe in. We did in the past company I worked with. They gave us great insights on what we did well and what we didn't do well, and where opportunity was to better serve our employee base. So that's something that we're going to deploy here in the next year or so for the company.
Well, that's great. Thanks, Rod. That concludes our Q&A session. I'd like to now turn it over to Rod for some closing remarks, and once again, thank everybody for joining us today.
So thank you, Drew. In conclusion, this is going to end where it began with our commitment to value creation for our stakeholders. The leadership team will be held accountable for keeping the commitments to our stakeholders, whether that's product quality or delivery to a customer. It's a promise of fair and equal treatment to an employee, or it's a commitment of returns to our shareholders. We will build a reputation for delivering on commitments. The business fundamentals are a cycle: growth to execution and disciplined reinvestment to yield future growth. Our team believes we have the path to define value creation, and our team is aligned and energized on the road ahead. So with that, I want to thank each of you for joining us today, and have a great afternoon. Thank you.